Hi there, ladies and gentlemen. It's James Marley here from Livewire, and I'm joined by Tim Carleton, who's the Chief Investment Officer of Auscap Asset Management. Tim, good to see you.
Likewise.
Now, we're going to be talking about Auscap's new Ex-20 fund, which is just about to get launched, and learn a bit about the strategy behind it. But before we get into the rationale for the Ex-20 fund, just wanted to give you some background on the firm. Auscap has been running their flagship Australian Equities fund, the Long Short Fund, for the past 11 years. It's achieved really strong performance. It's ranked in the top decile across different reported time horizons on the Mercer surveys. They just took out Fund Manager of the Year for their category at the Australian Funds Management Awards. As I mentioned, they're now launching an Ex-20 fund to add to that stable, and so we're going to be learning from Tim about the rationale behind the Ex-20 fund, what's going to be in it, and how it might differ from their existing strategy. So Tim, let's start off. What is the rationale for the new fund?
Well, the main rationale is just to have a very vanilla product. For a lot of people, the short side of the existing fund is quite complicated. For a lot of people, it's outside of their mandate. A lot of people don't like the idea of shorting, so this will be a very vanilla, long-only fund. Its mandate will see it invest primarily in the ASX 21 down to the ASX 300, so excluding the 20 largest companies in Australia, which represent about 57% of the index, but we don't see an enormous amount of opportunities within that space. So we're going to be primarily focused on the mid-caps and some of the small caps, and stick by and large to the ASX 300 universe in a long-only capacity.
And so why Ex-20?
Well, if you look at the earnings growth that the top 20 stocks have done over the last 10 years, it's pretty uninspiring. In fact, they've delivered compound earnings growth of about 2% over the last decade, and we don't see that changing. About 2/3 of the top 20 are made up of the banks and the miners. The banks suffer from declining return on equity. This has been a trend over the last 20 years. We don't see that changing at any point. And so if you've owned the top four banks, if you owned one share in each of the top four banks, you haven't seen any growth in earnings per share over the last decade, and we can't see that changing on a go-forward basis. The big miners are another big component of that top 20, and BHP, Rio and Fortescue dominate that space, and they're very, very heavily exposed to iron ore. And again, you know, Chinese demand has been growing exponentially and was doing so for 20 years. Their steel consumption peaked in 2020. We expect we're now on the other side of that demand curve, and their demand needs to decline for probably the next 10 to 20 years. So again, it's a sector that potentially has very significant headwinds over the medium term. And that represents the top 20 companies, you know, 2/3 of the top 20 companies in that index. So there's not a lot of excitement for us, because we are firmly of the view that if you look back through time, it's earnings that drive share prices. So if you don't see a change in the multiple that people are willing to pay for a particular company, then it's obviously the earnings growth plus the dividend yield that generates your total return. And if we look back through the last 20 years, the mid-cap universe in Australia has comfortably been the best place to invest. So since 2000, the mid-cap 50, which is an index within the Aussie market, has delivered over 800%. You contrast that with the All Ords or the top 20, they've delivered a little over 500%. And then the Small Ords, which gets talked about a lot, but it's actually been a very poor performer, has delivered only 200% total return over that period. So the mid-cap universe, by far and away, has been the best space to be. And the main reason for that is the compound earnings growth of those businesses. So over the last 10 years, the mid-caps have delivered 8.4% compound earnings growth as a group. That contrasts with the top 20 that's delivered about 2%, and the Small Ords, which has actually delivered negative 3% compound earnings growth. So it's the reason for the outperformance, and we look at the stocks that are in that mid-cap space and some of the small cap space, and we think that there's a very, very strong argument to suggest that you're going to see very good compound earnings growth on a go-forward basis, and that's what we want exposure to.
So in the new Ex-20 fund, is it that mid-cap space that you'll be targeting?
Yeah, it'll be predominantly mid-cap focused. So as I said, our universe is from the ASX 21 down to the 300 primarily. And within that, we would expect to have the majority of that exposure in the mid-cap space. So really the ASX 21 down to the ASX 100. But we will have an exposure to small caps. Most people in this market think that small caps extend from the 101st company down to the 300th company. They'll probably represent about 30% of the portfolio.
Mm-hmm. You talked about the outperformance of the mid-cap sector. Do you expect that to continue?
Yes, because I think ultimately it's driven by the earnings growth of the stocks in that space. And the companies that we're already invested in the existing fund, we think have a very bright future in terms of delivering strong earnings growth through the cycle. So simplistically, we view our job as finding businesses that we think will compound earnings at attractive rates over the medium to long term. Right? And if we find those sorts of companies, then our second obligation is not overpaying for them. So in an environment in which we're seeing valuations that are reasonable or better, and a lot of companies that we think will deliver very attractive growth over the medium term, that's a great environment for us to be launching an Ex-20 fund.
You've historically run the existing fund using shorting, sparingly. And you've also been underweight those top 20 stocks. You've talked about that there. Are there any other major differences between the Ex-20 fund and your existing fund?
Yeah, the biggest difference is the existing fund is really a high conviction fund. So we weight our positions in the existing fund according to our conviction, and that leads us to being significantly overweight some sectors and significantly underweight other sectors. And what that means from a performance perspective is there might be periods when we're very strongly outperforming, and then there might be other periods where we're underperforming, largely as a function of which sectors that we're exposed to. Because when a sector is performing, you tend to find that a rising tide lifts all boats, and similarly, if a sector is on the nose from a consumer sentiment perspective, then all of the stocks, irrespective of quality, tend to decline during that period. The Ex-20 fund will be sector aware. So we'll have a soft limit, 5% either side of the sector exposure that sector has within the Ex-20 index. And the objective there is to try to reduce the deviation of returns from the index. So we would expect the volatility of this fund to be lower than the existing fund, and we'll have a broader range of stocks across different sectors in which we're invested. So I think it's appropriate for investors that have a lot of funds that they're invested in and don't necessarily want to focus too much on why a particular fund is deviating from the index at a particular point in time, because we're trying to reduce those deviations.
And what gives you confidence that you can deliver returns across sectors?
Well, historically, if we look at our performance attribution and we divide the performance that's contributed to the existing fund by the average sector weight, actually the returns by sector are pretty uniform. Certainly we've been underweight some sectors, particularly in the last 5 years, and that's not surprising. I mentioned previously that for some sectors, as interest rates went to zero, their valuations went to levels that we couldn't justify. So think healthcare, information technology, infrastructure, utilities. And so as a result, we've had quite significant underweights in those sectors for a lot of the last 4 or 5 years. Well, finally, it feels like we're back in a more normal interest rate environment. Interest rates and the government bond rate are both above 4%, and that has led to a valuation reversion for a lot of those sectors. So for the first time in a number of years, we're seeing good opportunities in very good businesses across the range of sectors. And so from our perspective, it's an ideal time to start an Ex-20 fund that's sector aware. Let's
get to the nuts and bolts. Is there any benefit to investors of coming into the fund on the first day?
Yes, well, I'll be investing on the first day, and the obvious advantage is you don't have the bid spread, 25 basis points prior to the fund launching. So anyone that comes in prior to the 1st of December will benefit from that. But probably just as significantly, the mid-cap and small-cap indices have negatively deviated from the performance of the All Ords over the last 2 years. So the mid-cap universe is about 12% under the performance of the All Ords index since the start of 2022, and that's a pretty significant deviation if you look at the last 20 or 30 years and the periods in which it's negatively deviated from the All Ords. That has meant at a stock level that we're seeing attractive opportunities across that mid-cap and small-cap universe that we haven't seen, and particularly this diverse range of opportunities, for quite a number of years. So from our perspective, that's the real opportunity to come in and hopefully take advantage of prices that we find pretty attractive.
Okay, and if people want to find out more or they want to invest, what are the steps they need to take?
Well, you can go onto our website, auscapam.com, and you'll find all of the disclosure documents, and you can also make your online application. So you'll find the PDS there. It's a short form PDS because we're a vanilla long-only product, and you can also apply online or via the paper form.
Okay, well Tim, thanks for telling us a bit about the new Auscap X-20 fund.
Thanks, James.